Hi, this is Daniel, and you're watching Unrivaled Investing, a no-hype mission-focused channel trying to find you exceptional companies and unrivaled investments. Today, we're talking about how the Federal Reserve might have changed, especially with regard to its key influence over the stock market. For the better part of this past decade, the Federal Reserve has sort of been the backstop. Every time things sort of start going awry, the Federal Reserve's got your back with a new round of quantitative easing. But it's possible that they've now crossed the Rubicon, where they're effectively creating a situation that's ultimately going to make it worse for equity holders in the near future. And that's actually a point that Dr. Michael Burry brought up very recently. Let's talk about exactly what was Dr. Michael Burry saying that's effectively alluding to the idea that the Federal Reserve is setting up the situation where stock returns can actually take a hit. And so he called out how the Federal Reserve, by insisting that inflation is transitory, freezes companies from offering much higher wages that may become permanent, thereby creating more inflation through shortages, work shortages, and union strife, and now creating an oil spill. So let me break this down for you. So what he's saying is, because the Federal Reserve said, oh, yeah, inflation's not out of control. It's within our mandate. There are a couple of shortages here in terms of specific goods. It's transitory, which we know at this point is nonsense. But by constantly pounding the table saying, oh yeah, it's just this pesky transitory inflation, that's sort of given companies cover to say, oh yeah, we're not going to be raising wages. The challenge, though, is that enough companies are raising wages to deal with this sort of supply-demand imbalance. So we're saying, hey, we don't have enough laborers. We don't have enough workers to meet demand. You see that with restaurant signs saying, hey, we're going to raise the price. We're going to raise the rate in which we'll pay our employees because we need more people here. And you're seeing that with the number of job openings. And so what he's saying is, because the Federal Reserve consistently says transitory, 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 some companies, let's say like the ports, haven't been raising their wages as fast enough as they should to deal with inflation, resulting in even worse shortages where there's not enough labor to deal with the problem. Now, part of this is due to COVID, aspects, but part of this is also, what he's saying is, folks not raising their wages fast enough. And if you don't raise the wages fast enough, you actually start queuing up potential broader supply shocks because there aren't enough people stepping up saying, hey, I'm just not getting paid what I want to get. I'm not going to show up for this. And so what he's saying is that ultimately you're going to start seeing higher and higher inflation. And that ultimately drives lower stock returns. Why does that drive lower stock returns? Well, it drives lower stock returns because investors are going to come to expect higher interest rates to offset the inflation. And that's what we're starting to see, where in the last few days, the stock market has sort of stumbled along. The debt ceiling may get passed. And so folks are saying, hey, catastrophic risk has been removed, so the stock market can rally. Or, hey, there's this new COVID treatment from Merck, stock market should rally. But what you're looking at here is that interest rates are actually, so far through the month of October, creeping up higher. And it's not in a small way, because you might think, oh, going from 1.99% to 2.08% sounds, pretty small. But when you're dealing with such low figures altogether, it's actually a big relative change. For example, the move today from 2.02 to 2.08, that was a 1% decline for these longer dated bonds. And keep in mind, this is the security that Michael Burry is also short. So this starts getting really interesting, because as you have these bonds start selling off, then it starts creating pain for holders of the bonds. So then they might start selling off, in which case rates go even higher. And the reason why this is so important is because stocks, like all asset classes, are priced based on the risk-free rate, i.e., what can you get if you just put your money in a risk-free solution like a treasury bond. Now, it's not truly risk-free because, you do have inflation sort of eating it away. And, you do have this, even though it may have just been theater, really stupid theater in my mind, you did have that debt ceiling talk, potentially risking a default. So technically risk-free at around 2%, but it's creeping higher. And those small moves are resulting in, pretty material drops. A 1% drop, 1% drop the day before. And that sort of says to holders, wait a second, I'm starting to get crappy returns on my fixed income portfolio because rates are already so low. And if they creep higher, the price of my bonds start dropping very quickly. And so if you're an endowment, you're an institution that has, let's say, a traditional 60-40 portfolio where 60% of your portfolio is in equities, 40% is in fixed income, now you need even greater returns from equities. And equities are going to start coming under pressure because interest rates start moving higher, because interest rates are like gravity, especially for the more growth-oriented and unprofitable businesses. The businesses that are unprofitable where you're saying, hey, in the future, you're going to be generating lots of free cash flow. Well, that future, that is getting discounted at a higher and higher rate. So the price of those future cash flows start going down. And that's what you're starting to see here. That's what I'd argue is a core risk, where the Federal Reserve is actually starting to make this setup worse for investors by encouraging a setup of higher inflation. Now, what am I doing to consider this? What am I doing as I'm looking at this environment of stock prices sort of floating along, maybe move a little bit higher? The Federal Reserve saying, hey, we're going to be cutting back on QE. You do see potential supply shocks. You do see potential energy shocks. And you do see sort of the Federal Reserve potentially making the situation worse by saying inflation is transitory, potentially resulting in even worse inflation, potentially higher interest rates. So what am I doing as I consider all these things? So first of all, if you want to follow my personal journey, go to unrivaledinvesting.com, click join the journey. You can follow, first week of the month, I call out my full portfolio. By the end of the month, I try to call out a potential multi-bagger. Multi-baggers are types of stocks that could potentially go up hundreds or even thousands of percent over time. Now, so if that's what you're interested, go to unrivaledinvesting.com. So what I'm personally considering right now is a couple of different things, and you can see this across my portfolio, how I'm doing it. One is to have, cash for a rainy day. If this trend continues, and keep in mind, we're seeing huge deficits from the U.S. government. You are starting to see that uptick in inflation. You are seeing that uptick in interest rates. And so it does create that risk of could growth assets start to sell off in the near future? That's a big question mark, driven based on what Dr. Michael Burry was calling out. And so it is, in my mind, prudent to have some sort of cash. That way, some sort of liquidity for a rainy day if things all of a sudden reset to much, much lower because of some of these dynamics. Another aspect is to do hedging. Everyone can do it their own different way. I call it, how I personally use it, using effectively price action to determine when I'm going to do it. And so that's Unrivaled Investing Journey subscribers can know about that as well. I also, for my own equity, I'm not interested in really owning any bonds, especially given this dynamic where rates are so low that you're not being compensated at all for the inflation. So bonds are completely off the table. And so then that leaves this other component of how do you want to be investing in equities? If you own these hyper-growth companies, but they're really unprofitable, is there a risk that with higher inflation they really get discounted? So I think it's important to consider maybe a barbell approach where you have some companies that you're yes, I'm very confident that this company will generate meaningful free cash flow this year and next year. And maybe it trades at a reasonable multiple. So maybe they have the free cash flow to buy back meaningful amounts of stock if the stock starts dropping. So that's one aspect. And then the other aspect to the barbell approach is to say, hey, you know what? Even if this company is losing money, I expect that they're going to grow at such a fast clip, almost regardless of the economy. And then you start playing out, well, what if interest rates start rising? And you say, this company, even if interest rates move from 2 to 3%, which would be a huge drop in prices just because rates are so low. But you're saying, you know what, because this company is going to be growing at, let's say, 40% plus, you know what, I think I'm a little bit more comfortable. It'll grow into the valuation. I'm cool with that. Or finding companies that are at a reasonable valuation. So I think those are different types of approaches to deal with what I'd argue is a core risk that Dr. Michael Burry is calling out here, sort of saying, yeah, the Federal Reserve has likely shifted from being this sort of backstop that's led to equity markets constantly rising higher to sort of this conundrum now where they're starting to make the situation worse and will likely lead to pressure on stocks if this trend of bond prices dropping, yields start going up. If that continues, there's, in my opinion, no way it doesn't eventually hold down stocks and start pulling down stocks. If you see, for example, long-term bonds, the prices start dropping by 1% a day after day after day, and rates start creeping up by 0.1%, that's a big deal. And you could see the stock market reset based on that core risk. So what are your thoughts about this? How are you considering this sort of situation? Do you think, Dr. Michael Burry is just bunk and that he's completely misreading something? I'm curious to hear your thoughts, so leave a comment below. Thanks so much for watching.